Hello everyone, very good evening to all. Welcome you all in the session of Oliveboard. I hope you all are fine and doing well. Please confirm my audibility and visibility. Confirm my audibility. I hope everything is fine. Everything is perfect. I'm also audible. My slide, everything is good. So yes, let's start today's session with unit number 24 of module C. And the name of the unit is Restructuring, Rehabilitation and Recovery. See, in our previous all the units of module C, the module C is what it is to manage the credit management. The name of the module is credit management. And in this particular module C, all the units which we have covered, we have seen that what is the overview of credit management, okay, how credit risk can be minimized, how we can manage the risk, how the credit control is done, how credit monitoring is done, how the loan disbursement, okay, once the loan appraisal is done, how loan will be disbursed to the borrower. So all these things we have done, we have already covered each and every unit. After doing all these things, still there are chances that you have done the loan appraisal, you have done the credit monitoring, the bank has done the credit monitoring, the bank has done the credit evaluation, okay, credit control. After that, still one problem arises, and that problem is what? The risk of credit risk problem, the you can say the default, credit default. What are the steps, okay, how you will going to combat all these things. So in this particular unit we will learn what is credit default, how to combat your that NPA, non performing assets, what are the stressed assets, the RBI guidelines on restructuring of loans and advances, non cooperative borrowers. So all these things we will going to cover in this particular unit. I hope everything is fine, everything is good. Now let's start the topic. The first topic is credit default. See, credit default means what? It is comprised of two words. One is the inability, and the next is unwillingness. Now, what is inability and what is unwillingness? See, inability means you are not in a position that you can repay the loan which you have taken from the bank, which you have borrowed from any financial institution. You are not in a position to repay that money, not in a position, you are not able. Suppose it might happen for any reason, like you have incurred a lot of loss in your business, okay, your business not goes well, you have uh, done many expenses in your business. So all these are the reasons which you are not in a position to repay your loan. This is meaning of inability. Now, what is unwillingness? Unwillingness means you have the money, okay, you are in a position to repay the money, but you are finding the loophole. How to stay away, how to do the default in this case, okay, how not to repay the loan. You are finding the ways. That is unwillingness. You can be able to repay the money, but you don't want to repay the amount. That is unwillingness. And in inability, you are not in that position, you can repay the amount. Again, credit default arises because of inability or the unwillingness of a customer or counterparty to meet all the commitments in relation to lending. When the money was lended, so all the commitments which was made to the lending authority by the borrower. So if they have not met any of the commitments, if they have not repaid the amount, then credit default arises in that case. In case of direct lending, principal or interest amount may not be repaid in case of direct lending. In case of guarantees or letters of credit, guarantees means what? Suppose Bank has given the guarantee to the hurt person that if this person, okay, you want to, this person wants the money from this particular person. Let's take A and B. Okay. A is asking money from B. B says, I don't know you. Okay. We are not business partners. I will not going to lend you the money. But in this case, the bank of A will come and say, okay, lend the money to A. This is the supplier. Let's say lend the money to A. If this person will not repay your money, then I will repay your money. So this is what guarantee. Banks become what? Banks become the guarantor in this case. Now, in case of guarantee, funds may not be forthcoming from the constituents on this person, the borrower. In case of treasury operations, okay, the counterparties, they are not fulfilling the contracts which they have made. They are not agreeing on any particular scenario. So in case of securities business cases, the settlements of securities are not done due to the default made by the parties. So credit default, it may occur in any ways, in any cases. It just means inability or unwillingness of a customer. Now, next is, what are stressed assets? Although we have completed the stressed assets and NPA in our previous units also, but still, let's have a look over here. Now, stressed assets are loans or advances that are at risk or default. See, what happens? We know that credit default arises when there is non-repayment of what? Principal amount as well as the interest amount. So, credit default arises when there is non-repayment of principal as well as interest amount. And this case will develop what? The chances of NPA. The chances of NPA will develop more in such things. So stressed assets are those assets that are at risk. Risk of what? Default. Means there are chances that already the default has been made, or there are chances that there might default in coming scenario. So when there are chances of happening of a default or they have been occurred, that are known as stressed assets. So these are loans where the borrowers has either already stopped repaying or it is showing a sign of non-repayment due to any kind of issues. It is critical for banks, financial institution, financial intermediaries, because they will impact what? They will impact the profitability of the business. They will impact the profitability of the bank, because bank also don't want that their profitability goes down, their credit rating goes down. So bank, the profitability will impact. And these stressed assets, they are broadly categorized into three types. The one is non-performing assets. Again, the non-performing, when the borrower has failed to pay the interest amount, the principal amount for more than 90 days, then that becomes what? NPA. Till 90 days, the bank will wait. After that, if 91 days, if the amount is not received by the bank, then it declares that as NPA. Yeah. So we have different categories in NPA: the substandard, the doubtful, or the loss. Substandard, when the NPA, when the assets remain non-performing for less than 12 months, that is, it should be what? It should be less than 12 months. Clear? Now, remain non-performing for more than 12 months. It should be more than 12 months. And considered uncollectible means finally a time comes when the bank feels that, okay, now I'm not going to recover my money back. So let's declare all these assets as loss assets. Clear? So these are the categories of non-performing assets. So there are two types of categories: performing and non-performing. So non-performing includes substandard, doubtful, and loss assets. Now, next is restructured assets. Means restructured asset means that where the bank wants to help the customer. Basically, customers are who? The borrowers. Bank will say, okay, they will say, okay, the interest was 12% on 10 lakh of loans. Now, okay, I'm reducing this interest. I'm reducing it to 8%. Now, please refund my money. Please repay my money back, I have decreased the interest rate. In this case, what is happening? Bank is helping the customer. Bank is helping the borrower so that their money can get back. They can recover their money. That is restructuring what the asset. Loans with the repayment terms have been modified. Modified means they have been changed. Changed for whom? For the borrower, to help the borrower overcome financial difficulties. Okay, I know that the bank will say to the borrower, I know that your business is not working good. Okay, you're not gaining a lot of profit. You're occurring more losses rather than profit. Okay, I'm decreasing the interest rate. Now please repay my loan. So basically, restructuring is done for what? For avoiding NPA, for avoiding non-performing assets, but it still indicates stress in the borrower's financial situation. So restructuring, it basically help out the customer in different ways. And still, if the customer is not able to pay the loan back, not able to repay the loan, then the bank it still indicates stress in the borrower's financial situation. Then return of assets. Now, finally, when bank will feel that okay, I'm not going to recover my money back. Okay, I have lost all my money. The NPA category, the lost assets, then they will declare all of their assets as written off or lost. So loans that the bank or financial institutions has written off as bad debts. Now bank has written off those assets as bad debts. After seeing that now no more I'm going to recover my money back. So these loans remain in bank's book, but they will no longer generate any kind of income. So they have become non-incomable assets. Now, there is one important topic, that is provisioning coverage ratio, PCR. See, what is PCR? If you will see that provisioning means if any kind of provisions are made, we know that in future I might be having a loss of 10%. So for 10%, I may make a provision now itself only. I will make a provision. So provision is what? That you are making a category where you are keeping, where you want to recover all of your losses. That is the provision. It is a key financial metric used by bank financial institutions for what? For measuring their ability to cover non-performing assets with the provision. So basically for non-performing assets, the provisions are made, and under these provisions, there has been a little hope that might I will recover my money. It reflects the extent to which a bank has provisioned against bad loans and is indication of financial stability and also minimizing the risk, managing the risk. So it has a formula, that is formula for PCR, provisioning, provisions for NPAs, non-performing assets upon total gross NPAs into 100. Suppose let's take a example. Suppose the bank has a portfolio. Bank portfolio is of 5,000 crore. Just a minute. Okay, bank's portfolio is 500 crore. Now, in this bank's portfolio, what is happening that the NPA is how much? Okay, NPA occurs 550 crore. Now, 50 crore is the NPA that occurs in the bank. Now, the bank has made a provision for NPA. How much provision is for NPA is made? Provision for NPA is made just 5 crore. Now, what is the formula? How to calculate the provisioning coverage ratio means the there are chances there the provision has been made, and it has been made so that we can recover, so a bank can recover the NPA. So what is the ratio of that? The provisioning coverage ratio. So provision for NPA. Now what is the provision for NPA? It is 5 crore. Total gross NPA. Now Total gross NPA is what? The NPA, this is what the total 50 crore into how much? Into 100. 0 0 cancel, 5 5 cancel. So how much is left? 10%. Means the bank has made from its 500 crore 10% of the provisions related to NPA. If I ask that what is net NPA, what is net NPA? Then net NPA is what? Upon in from 50 crore NPA that has been arised, how much provision the bank has made? Bank has made just 5 crore provision. It means the net NPA is 45 crore. The provision for NPA is amount set aside by the bank to cover losses arising from bad loans. The provision for NPA was how much? The provision for NPA was that bank kept aside, that is 5 crore. And gross NP, the total value of non-performing assets. So total value was 50 crore, but the gross NPA was provision for NPA that bank has made separate so that they can cover losses which has been arised from the bad debts, that is 5. So this is how we can find the PCR, provisioning coverage ratio, and it is very important. The full form as well as the formula. Done. Now, what are the options available to bank for stressed assets? So, see, we have seen that credit default arises when there is non-payment of principal as well as the interest amount. So, for this, bank has three types of option. What are the three options? The first is rectification. Rectification means the correction. The bank will correct the correction. Second is restructuring. And third is finally bank will do the recover from various sources. So every credit default does not necessarily result in loss to the bank. There are chances that they may recover their loan. In many cases, banks are able to recover their dues with the help of three options, that is rectification, restructuring, and recovery. And there are some scenario also where the bank will recover no of the amount. None of the amount the bank will recover. Now, what is rectification? Rectification means if bank will say, okay, I'm giving you the opportunity to correct your mistakes. You have not paid the amount in, let's take an example, in the month of March, in the month of April, in the month of June. Now in July, pay the rest of the month of the amount, and after July, make it regular. This is what the regularity under rectification. Clear? Now, restructuring is what? Again, restructuring, if bank will help the customer that, okay, I will I will less the interest rate, now repay my loan, I will give you the concessions, I will give you relaxation on the interest rate. That is restructuring. And finally, so restructuring is done before first the government will give you the rectification. Okay, now rectify. You have not done payments from the last 5 6 months. Pay those amount and after that do it a regular. Okay, the borrower will not is not take into very it will take he will take into granted. Restructuring, the bank will say, okay, I am uh, giving you concessions, I am giving you relaxations on the interest rate, now please repay my money back. Then still they have no, you can say the borrower will not going to do the same thing which the bank is telling. Now last option is what? The recovery option. So recovery is the last, because last stage is taking the legal action, taking the SARFAESI Act with the help of debt recovery tribunal. Okay, with the help of various things, they will try to recover their amount back. So this recovery is little bit very a negative sense, because it will hamper the borrower. It will hamper the borrower as well as it will hamper the bank's goodwill. So that is why banks are giving the opportunities to the borrowers that, okay, I'm giving you chances to recover my loan. At least I'm I have given you that, okay, the interest rate is, I have down the interest rate from 12% to 8%. At least now you recover my money. But no, the borrower will not do that. So the last stage is what? The recovery. Again, so we have seen in rectification the regularization. Okay. So I have given you the example over here. This is how the borrower bank will ask the borrower that, okay, now you can give me the regular loans. That is the regularization. The best solution to encourage the borrower to pay all the overdue amount. And after that, once the overdue amount has been paid, after please make it a regular. Okay, regular payment. That is regularization. Now, next is exit from the account. Then if bank will see that, okay, this is the account holder like xyz person, name of the person is xyz. Okay, this is the account holder. I'm seeing that this person's early signs are not very good. Okay, showing the early warning signs that in future this particular account holder will make default. So what I will do, I will take the initial steps right now. I will the this works best if the stress is identified early. If the stress is identified early, that yes, in future this particular borrower will make any kind of default. So the borrower can move their account to another bank. This is one. The bank's first priority is to exit from accounts which shows early signs of financial stress. So these are the things which a bank can take a help of doing the exit mode. If the signs of stress become more obvious, it is difficult for a bank to accept it for the another account. So they may shift it to another bank. They may ask the borrower that please close your account, okay, repay all the money, and you can open your account in some other bank. So with the help of consortium, with the help of multiple banking facilities, okay, so these bank the loan may be share with different banks and the exit can be done. So yes, this is very problematic and challenging for banks. So they see early warning signals, and if they see that, they will take initial steps for that. Mm. What are non-cooperative borrowers? See, if you will see, it consists of three words. We know what are borrowers, the one who borrows money. Cooperative means what? The one who is very cooperative, means who is very supportive. Cooperation means a support, a proper guidance, a mentoring. Now, if we write non, it means the person is not supporting, it is not giving proper guidance. So, non cooperative borrowers are those borrowers who are not supporting to the bank. They are not repaying their money. Okay, they have the money, but they are unwilling to repay the money. They are not repaying in the timely repayment of dues. So, basically, what happens, they are not supporting the bank, they are not cooperating the bank. That type of borrower is known as non-cooperative borrowers. A non-cooperative borrower is one who does not engage constructively with her lender. Lender is what the bank by defaulting in timely repayment of dues while having ability to pay. They have the ability to pay, but still they are not paying. They are not cooperating with the banks by not providing any kind of necessary information, by disclosing every information, by denying the access to assets, by not giving proper collateral securities, by obstructing the sale of securities. So basically this person is doing a default, who deliberately stonewalls legitimate efforts of the lenders to recover their dues. Means the borrower is standing like a wall in doing cooperation, standing like a wall, not supporting at all, always you can say saying, okay, I will pay it later on, I will pay it later on. Okay, non timely repayment of dues means the borrower is standing what like a wall between the bank and the bank's ability to work hard so that they may get their loan back. So the first thing is they are not supporting the bank and they are not giving their dues, they are not repaying their dues, they are not giving dues on time, and they are not supporting the bank as well. So basically, this is standing what like a wall between bank. So bank wants to take the help from this, but this person has created a wall so that bank cannot take a help. Okay, they are have become a non-cooperative borrower. Now, what are the RBI guidelines for restructuring of loans by banks? Bank can restructure loans that are categorized on standard, substandard, or doubtful. But those with backdated effects, the bank cannot restructure that loan, which has the backdated means the old date. Okay, the old date scenario, the bank cannot restructure the loans. A loan will only be restructured when it is financially viable, important, okay, and there is reasonable chance that the borrower will repay the loan. If there are chances that this person, the borrower, might repay your loan, then the restructuring policies will be created by the bank to the borrower. Restructuring must consider borrower's cash flow. What are the cash flow of the borrowers? How he is being taking his companies. Okay, what are the cash flows in companies? What are the earnings? What are the profits? And the feasibility of the project or activity funded by bank. So means basically the restructuring is what helping the customers so that they can pay the loan. Bank can recover the loan which they have granted to that borrower. And if these borrowers are not cooperating, not supporting, then it means that they are hiding a weak loan, okay, which could lead to regulatory action. So borrowers as well as the bank both should support each other in case of restructuring. If bank is decreasing the interest loan rate, then the borrowers should come forward and repay their loans back to the bank. This is how the restructuring is done. Okay, so yes, we have done few important topics related to rehabilitation, then restructuring and rectification. So three main options are very important: the restructuring, the rectification, and recovery. First, bank will give you chance to rectify your mistakes to the borrower. Then bank will give that, okay, I'm restructuring your loan. I'm decreasing the interest rate. Okay, I'm decreasing the burden of your interest, the restructuring. And still, if the borrower is not getting ready, not repaying the loan, then the final action is what? The recovery. That is the legal action where bank will take the help of debt recovery tribunal, SARFAESI Act to recover back its loan. SARFAESI Act 2002. Okay. So this was all about today's session. We completed unit 24 and tomorrow the unit 25, that is, I guess, unit 25 is a resolution of stress assets. So this will be the last unit of module C. After that we will start our last module, that is module D, the compliances by banks. So I hope you have enjoyed the session. If you have enjoyed the session, kindly like the video, share it with others. And moreover, if you have not yet subscribed our YouTube channel, the Oliveboard GIB CIB English Medium YouTube channel, then please subscribe it so that whatever videos we will upload, we will come live. So you get a notification and you can easily join that video. So, okay, let's meet tomorrow at the same time. Till then, take care, everyone. Goodbye. Keep studying, keep watching.